All right, thanks very much for joining me today. Once again, my name is Tim Parks, and I'm here presenting today on behalf of Davis Shilkin PC. This month's topic is taxes. April is tax month, and so that's the presentation we're doing this month. And so we're going to go through some current tax laws, some proposed tax changes, and then we'll take a look at some tax planning strategies. So I'm going to share my screen, and then we can jump into the presentation. All right. So let's go ahead and get started. We always like to start with Davis Shilkin PC. We always like to start with our definition of estate planning. And it says, I want to control my property while I'm alive, take care of me and my loved ones if I become disabled, and give what I have to whom I want, the way I want, and when I want. Furthermore, if I can, I want to save every last tax dollar. That's today's presentation. Professional fee and court costs legally possible. So again, we're going to be taking a look at the tax portion of this. As far as our agenda, I kind of went through this a little bit. We'll take a look at some current tax laws with regards to estate tax, gift tax, and then some individual taxes. And then we're going to take a look at Biden's proposed tax plan and some changes, and then we'll end with some tax planning strategies. So jumping right in, the estate tax exemption amount per person in 2021 has been increased because of inflation to 11.7 million. And there's an asterisk by there because that does go up each year. This is doubled for married couples. So with portability, a married couple can combine their estate tax exemption amount by using the deceased spouse unused exemption amount, often referred to as DSUA. Portability does not apply to the generation skipping tax transfer, so the GST portion there. So this 11.7 million does apply to estate taxes. It also applies to a lifetime gifting exemption amount, which we're going to take a detailed look at in a little bit later, and to your generation skipping tax exclusion. The other asterisk there is that this is scheduled to sunset at the end of 2025. So that means if no new laws are passed, because they passed this with just a simple majority through Congress, it has to have an equalization principle. And so the law is scheduled to revert back to what it was at the end, before the Tax Cuts and Jobs Act, at the end of 2025, if no new laws are passed. And we're going to take a look at some proposed new laws. The 2017 Tax Cuts and Jobs Act also revised some tax brackets for individuals and for trusts and estates. So there's the 7 tax rates for individuals depending on the income bracket, and there are 4 tax rates for the estates and trusts, again depending on the income and income bracket. Trusts have what we call a compressed tax bracket, and so just to illustrate this for you so you understand the taxes that are paid out of a trust on income earned, it's compressed because you reach the top percentage of the tax bracket fairly quickly on income. So the taxable income over there on the left, it says if it's between $0 and $2,600, then 10% of it is taxed. If it's between $2,600 and $9,500, then there's a one-time fee of $265 plus 24% of anything over the $2,650. And then if you're between the next bracket, 9,551 and 1,350, then there's a fee of 1,921 and a 35% fee of the overage. And then anything over $13,051 is taxed at 37%. So when you think about income that's earned, that $13,000 is pretty easy to meet. And so you're going to be looking at the highest tax bracket pretty quickly for income that's earned to a trust. And so a lot of times what will happen there is the trust will have a provision that requires that the income be distributed out of the trust annually so that the individuals will pay the income at their own bracket instead of the trust bracket. That's not always the case, but a lot of times that does come up. All right, so the standard deduction, right now it's $25,100 for married couples, $18,800 for head of household filers, and $12,550 for all other taxpayers. The deduction for the personal exemption has been suspended. Basically, it's reduced to zero. So people, almost everyone is just filing the standard deduction. Because of this, you don't get as much out of your charitable distribution. So if you are someone who contributes to charities regularly, then you may want to get some sort of tax benefit out of that. Because of the higher standard deduction amount, you're probably not really getting anything out of your charitable deductions other than your own intrinsic reward. So because of that, we are talking to people about possibly setting up what's called a qualified charitable deduction, or a QCD, out of a retirement plan. So what you can do is you can actually direct your plan administrator to make a payment directly from an IRA to the charity without going through your bank account. And if it satisfies the QCD requirements, then it can be part of your required minimum distribution, and it reduces your total taxable income. So that's a way, if you are trying to sort of proverbially kill two birds with one stone, you can get the charitable deduction and satisfy your charitable contributions through this QCD. You don't get the charitable deduction, I'm sorry. You get the, you lower your taxable income. So that's the QCD. And if you are curious about that, you should talk to your plan administrator about trying to set that up. You also have the Section 199A, the 20% deduction of qualified business income, which benefits sole proprietorships, partnerships, LLCs, S corporations, rental real estate, and trusts and estates. So we still have the qualified business income deduction. Okay, so transitioning a little bit to Biden's proposed tax plan. These are some things that we're watching. We're wanting to see. We have no certainty at all when this could get passed. With a divided House, divided Senate, it might be difficult for us to see anything really progress on this. But this has been this is what has been proposed. So, and this was while he was campaigning. So we talked about the high estate tax exemption amount. There's right now it's at 11.7 million per person, so 23 plus million sheltered between married couples, and anything over is currently taxed at about 37%. Here, Biden has proposed reducing the estate tax exemption amount to 3.5 million. Still a pretty high number. A lot of Americans will not have a taxable estate under that amount, and of course, if you're married, you can combine that. But anything over that amount would be taxed at 50%. And then the individual income tax rates the highest rate would be raised just a little bit there. And then you would bring back in the Obamacare tax rate of 3.8 and the Social Security payroll tax of 6.2. So you add all that up for income over $400,000, the applicable income tax rate would be about 50% or 49.6%. So that's on the income taxes. Capital gains, there's been some movement here recently. Right now, the dividend rates would remain at 15 or 20% for income over 445. However, anything over 1 million in capital gains would be taxed at the 39%. Additionally, there's been some proposed legislation to eliminate the step-up basis at death. So currently, if you pass appreciable assets to your loved ones by way of an inheritance, you do have the advantage of a step up in the cost basis of the asset, so that your loved ones effectively pay zero capital gains if they liquidate the property around the date of death. Biden has proposed eliminating this with an exemption of $1 million per person. Hard to tell exactly what that would, when that would be accomplished or passed, but that is something that we're watching. Biden has also proposed eliminating the like-kind exchange for real estate. Right now, real estate is, I believe, the only remaining thing you can use the like-kind exchange for, and so Biden has proposed removing that as well, and removing the 199A deductions for qualified business income for real estate. And then finally there, the Biden tax plan would increase the corporate tax rate to about 28%. Not a huge difference there, I think maybe 6%, but a little bit of an increase as well. So these are some of Biden's proposed changes. I sort of already mentioned this. It's very difficult to tell exactly when this would happen. I think some of them we're very likely to see, such as the reduction in the estate tax exemption. When it comes to taxes, that sometimes ends up being what they call the low-hanging fruit because it's so easy to pass that. It's easy to reduce that. And so that pendulum kind of swings back and forth depending on who's in office. But we have also heard proposal that this be implemented retroactively to start at the beginning of this year. So we are trying to review these things and try to stay on top of it and keep you informed with anything that we see coming along. Okay, talked about gifting. So because of the Biden proposed tax plan, of course, we are starting to get some more conversations around gifting. So what can I give away now? How much can I give away now so that if the estate tax exemption amount is reduced or the gifting exemption amount is reduced, I can take advantage of that? Just as a little bit of a recap, the 2017 Tax Cuts and Jobs Act roughly doubled the exemption amount until 2026 or early repeal. However, clients often incorrectly believe that any gifts above the annual gift exclusion use up the temporary higher applicable amount first instead of their base amount. And we're going to illustrate this with a diagram. So if you're not tracking yet, that's okay. However, this is actually a bottom-up calculation that uses the base exemption amount first. So let's take a look at this in a diagram so we can kind of make this make sense. All right, so what you see there, the yellow box on top of the blue box, that represents the current lifetime gifting exemption amount. Now, we are referring to the bonus exemption amount is anything that's over what the base exemption amount was. So before 2017 Tax Cuts and Jobs Act, you had the base exemption amount of about $5.49 million per person. Along comes the 2017 Tax Cuts and Jobs Act, and it raises it to what it is today at 11.7 million. When this was done, it was 11.58 million. That's for 2020. So that amount higher is what we're referring to as the bonus exemption amount. Now we know, based on the law, that if there's no new laws passed, and this is where the arrow moves, after 12/31/2025, it will go back to the base exemption amount. So that bonus exemption amount is only available at a maximum until 2026 if no new laws are passed or nothing has changed. So what people are trying to do is take advantage of that higher amount now so that if it does go down, they have taken advantage of it while it was higher. And in fact, this is what the IRS regulated. They put this in, it's called the anti-clawback provisions. So the anti-clawback provisions under the IRS say that if you do take advantage of the higher exemption amount now, that it's not going to be clawed back into your taxable estate at your death should it go back down later. So people are wanting to take advantage of this. However, as the first bullet point says, to take advantage of the bonus exemption amount, clients are asking about gifting now. To use it, a client needs to gift more than the base exemption amount because that's what you use first, and then you use the higher exemption amount. And so we've got some examples here where we will illustrate this. So in the first example, a client decides that they want to give a $3 million gift above the annual or the $15,000 gift exclusion amount. So they gift $3 million. And what they're hoping is that this $3 million will use the bonus exemption amount before it uses the base exemption amount. But you can see on the gray highlighted area there that the clients actually only used their base exemption amount. They didn't use their bonus exemption amount at all. And so when the law changes and it goes back down, they have inadvertently only used their base exemption amount, and they only have whatever is remaining in their base exemption amount. So to take advantage of the higher gifting exemption amount and the higher lifetime gifting exemption amount, clients need to actually gift more than the base exemption amount. So in this example, the client increased their gift from 3 million to 8 million. Now they're above the base exemption amount of 5.49 million. And in fact, they're eating into the higher exemption amount. So you can see the gray lines there illustrate the gift. And this gift actually does use the bonus exemption amount. In this situation, because they use their bonus exemption amount, if the exemption goes down, that's not going to be clawed back in, and they did actually take advantage of the bonus exemption amount while it lasts. So to summarize this, clients who are asking about gifting, if you come to me and say, hey, I just want to gift a $1 million gift of my real property to my kids now because I'm worried about the changes in capital gains and because I want to get it out of my estate, you can do that, obviously, but you're not using the higher gifting exemption amount. And so if the laws change and it goes back down, you may be using up what is remaining for you when the laws change. So that's sort of to illustrate this advanced gifting, and it's something to be aware of when clients ask about gifting. When it comes to tax planning and strategies that we look at when these laws change, of course, your circumstances and your goals are going to be the dispositive factors that we look at. What are you trying to accomplish? Would you even have a taxable estate? I've had clients come in and talk about, well, I just don't want to pay any taxes. And based on their net worth, it seems very unlikely that they would ever even have to pay an estate tax exemption now, unless the laws drastically change. So could you have a taxable estate? Do you have other specific goals that we can pair with your strategy? Are there charities and things like that? We are encouraging people to be careful about the wait and see approach. Of course, that's our job, is to wait and see what happens and to keep you informed. But we want you to be aware ahead of time so that you can take the right steps in an optimal strategy. Okay, so let's talk about some advanced tax planning. This is one that we'll probably see return a little bit if the estate tax exemption does go down. This is a spousal lifetime access trust, often referred to as a SLAT. A SLAT is an irrevocable trust. And what happens is one spouse sets up a trust for the other spouse, and they can include descendants if they want to. This is a third-party trust. It's not a self-settled trust, and we'll make use of a floating spouse provision. The floating spouse provision comes up a little bit later when we're talking about this, but you can use that term spouse to mean any spouse that you're married to at the time. So if you end up getting divorced and remarried, the spouse provision, and that's what we call a floating spouse provision, and the grantor usually retains the power to fire and hire trustees. Now, the idea behind this is that assets are gifted to the spouse or to this trust ahead of time. So we talk about on the slide here a completed gift versus an incomplete gift. And for the focus of tax planning, we're mainly going to be looking at a completed gift. If you did an incomplete gift SLAT down there on the bottom, the main benefit that you get from that is the creditor protection because you're gifting the assets away. However, the assets are generally considered a part of your taxable estate at your death, so you don't get the same tax savings, as opposed to a completed gift, which does give you the estate tax savings and the creditor protections. However, with a completed gift, you cannot retain the power of appointment, in other words, to change out the beneficiaries, and you can't retain a power to veto distributions if someone is making a distribution that you disagree with. So it's a little bit more restricted, the powers that you give. However, there's the trade-off is the tax savings. Why does this avoid estate tax inclusion? To summarize this slide, you can read through these later if you'd like to, but to summarize it is you are giving away the asset now and not retaining the control or the interest in the asset. And so because of that, it's not considered part of your taxable estate. Those are the specific sections that are listed over there that we reference when drafting these. What if you need the assets out of the trust? What if you gift something, but you actually do need some money? You have a health need at the end of your life and you need long-term care or something like that. Well, with a completed gift, a spouse as the beneficiary, they can take distributions and then they can loan those back to the settlor, or they can exercise a power of appointment to the settlor. So there's some flexibility for your spouse to operate that. With an unmarried client, it seems extremely counterintuitive to have an unmarried client set up a spousal lifetime access trust. And of course, there are other irrevocable trusts available, but you can use the floating spouse provision. So if you think you're going to get married in the future, then you could set this up for your future spouse, and you can interchange spouses if you got divorced and then remarried. However, if you're working with a completed gift, which we would be for tax purposes, this is a very important upfront consideration that someone would want to make. Other consideration, if you are going to fund a SLAT with life insurance, you have to be careful about incidents of ownership. And when we get to the ILIT trust, the Irrevocable Life Insurance Trust, we're going to take a closer look at those. And then the big thing for SLATs is two spouses come in, one spouse wants to set up a SLAT for their spouse, and the other spouse wants to do the same thing. Well, the issue there is what we call the reciprocal trust doctrine. If you set up a SLAT and your spouse sets up the exact same thing, then the underlying portion on the screen there may apply, and it says this case found that it leaves the settlors in approximately the same economic position as if they'd created trust naming themselves as the life beneficiaries. So if you're not in a different economical position and you're in the exact same position, then it's probably not going to be a valid trust, and it's going to violate the reciprocal trust doctrine. So you want to make sure that you have non-reciprocal SLATs, and sometimes the way to do that is to have one spouse as the beneficiary, and then for the other trust, just have the descendants as the beneficiary, not the spouse. So there are ways to do that, and if you're looking for two SLATs, that will be the way to do it. And then what if you get divorced? Well, we've already talked about the floating spouse. Okay, so those are SLATs, and that's a spousal lifetime access trust, which you can transfer assets out of your estate ahead of time. What about an irrevocable life insurance trust? And for those who set up their estate planning under the very low exemption amount of about $600,000 per person in the early 2000s, this was a pretty popular technique. And so we're going to take a look at it again as the state tax laws change. An ILIT, an irrevocable life insurance trust, is an irrevocable trust that's funded with insurance. Now, there may be different reasons for purchasing insurance. You might want to replace income. You might want to have liquidity at death. You might want to equalize out an inheritance if you're giving a house to someone and you want to give insurance to the other. Wealth replacement, business, succession planning, whatever the case may be, there's a lot of reasons for insurance. But you do want to make sure that the insurance is used for the intended purpose. And so instead of just buying an insurance policy and making someone the beneficiary, hoping that they'll use it how you've intended, you might want to consider funneling those insurance proceeds through a trust, and the trust then dictates the terms of what the proceeds are to be used for. Additionally, this is a very popular way to get assets out of your estate because you're gifting to the trust. So this could be violated. However, the insurance would not qualify if the insurance is owned by the decedent. So you want to make sure that it's owned by the trust. If the proceeds are paid to the estate and not to the trust, if it was transferred within 3 years of the death, if they're mandated to pay obligations, or, and this is what we talked about previously, there are incidents of ownership. So what are those incidents of ownership? Here are some examples. The right to assign the policy, the right to revoke the assignment, the right to change beneficiaries of the trust, the right to cash in the policy or pledge the policy for a third-party loan. If you have any of those rights associated with the insurance you've selected, then it is going to be clawed back into your estate, and it's going to most likely be part of your taxable estate. So to get it out of your estate, you have to check off those things to make sure that that's not accomplished. So what are the steps in creating and funding this type of a trust? First of all, you want to set up the trust. Secondly, you then need a separate tax ID number for the trust. And then the trustee files an application for the life insurance. Trustee opens a checking account, and then the trust maker, the grantor, the person who sets up the trust, gives the gift of the premiums to the trustee. So whatever the premiums are, the trustor, the person who sets it up, is going to gift those to the trustee to pay the premiums. The trustee then has to give notice to the beneficiaries of their withdrawal right, called a crummy notice. We'll take a look at in just a second. And then if they do not exercise that withdrawal right, the trustee pays the premiums. And so that is the procedure for setting up an ILIT. What are some advantages? I think some of these seem pretty obvious. The proceeds of the insurance are held by the trustee selected by the grantor, and you can have professional management. You can determine the terms under which the beneficiaries will receive the proceeds. This goes to that control aspect, making sure the proceeds are used what you want them to be used for. Making sure that the proceeds are removed from the estate. So this is the big one for tax planning. If you have $1 million proceed paying into an ILIT trust at your death, you do not want that $1 million life insurance proceeds to be part of your taxable estate, so we can get it out. There's spousal planning involved, and potentially generation skipping transfer planning involved as well. Excuse me. What are some disadvantages? And I think these probably also speak for themselves. The cost to set it up now, the time and the energy and the work. If you have a professional trustee, you're going to have to pay the trustee's fees. There may be special permission required for the trust to qualify for the annual gift tax. There's some complications there. You do have to outlive the 3-year period. If you do not survive it, then all the work and the costs that you spent might be for nothing. And then you lose the flexibility and the access to the policy. These are not impossible to unwind, and I don't want you to get that impression. But as the name implies, they are supposed to be irrevocable, and so it makes it a lot more complex to try to terminate a policy and to get it out if for some reason a need arises. What about qualifying for the annual gift tax exclusion? The goal here is to gift under that annual gift exclusion so that you're not eating your lifetime gifting exemption amount. And so you want to remove the policy from the insurer's gross estate at the least possible gift tax without diminishing the available unified credit amount, which is what I was just saying. You want it to be under that annual. You need that to qualify. And then absent special provisions creating a present interest, a gift to a trust is a non-present interest gift and does not qualify for the annual gift exclusion. So how do we solve that? Well, this is where the case Crummy v. Commissioner comes into play. And if you've worked around ILITs or have an ILIT, you have heard the term a Crummy notice. Under this case, you are required to send notice to the beneficiaries that they have a right to access the gift. And if you don't do that, then it's not a present interest gift. You want it to be a present interest gift, and so that it's not part of your annual or your lifetime gifting exemption amount. And that was codified under the revenue ruling there. What about the grantor as trustee or the insured as trustee? You do not want to have the insured as the trustee. Insured grantor who serves as trustee will be deemed to have incidents of ownership. We talked about those already. And then what about the spouse? Well, this is discouraged. It's not automatic grounds for imputing the incidents of ownership, but it does create some risks. So we usually want to look for a third party or disinterested person. So there's some, so we mitigate some of those risks of that being called back in. Okay, so that's an ILIT. The next one is a GRAT, a grantor retained annuity trust. A GRAT is a trust that you create for a specified term of years, and that's the term. During that period, you will receive from the trust an annual annuity payment expressed as either a fixed dollar amount or a fixed percentage of the initial fair market value of the trust property. The trust can pay you the annuity either in cash or in kind based on the value of the property. And then at the end, the remaining principal of the trust will be distributed or held in further trust for the beneficiaries. Now, if you're not tracking that all the way, we do have a diagram to help you understand this visually, what's going on, and that's right here. So here's what happens. All the way on the left there, you have the client, and the client sets up the GRAT, the Grantor Retained Annuity Trust, and they give to the Grantor Retained Annuity Trust an asset that they believe is going to go up in value. So it could be a business, it could be investments, it could be something that's going to go up in value. So they gift that to the asset. Now, that's going to be considered part of their lifetime gifting exemption amount. It's going to eat that up unless they do the annuity payment back. So they calculate ahead of time what the annuity payment back would be. And over the term of years, 3, 5, 7 years, whatever the case may be, they're going to receive an annuity payment, either fixed or variable, depending on the way that they want to set it up, of the asset. So the principal that they're gifting is supposed to effectively be then gifted back to them from the trust. However, because the asset went up in value, the remaining amount, so the part that's past the blue line, that then stays in a trust or it's gifted to future beneficiaries. So that is a way for you to get rid of the appreciation on assets out of your estate ahead of time without triggering a taxable event. So this is a Grantor Retained Annuity Trust. So we're going to go through some of what I just talked about here in the words. So your gift to a GRAT is a taxable gift that will use some of your remaining lifetime gift exemption amount. And the amount then is equal to the fair market value of the property transferred less the actuary value of the annuity payments that you receive. So you do that math ahead of time so that you're not using your lifetime gifting exemption amount because you want them to zero out. The actuary value of the annuity payment is based on several factors, including the IRS interest rate in which the GRAT is funded, the length of the term, and the size of the annuity payments as a percentage of the initial fair market value, in other words, the payout rate. So we have software that we use. You have to know your numbers on this to make sure when you're doing these calculations that it makes sense and that it's going to work and accomplish what you want it to. So that is a Grantor Retained Annuity Trust that is very good for passing on assets you believe are going to appreciate in value. All right, what are some other strategies? Well, one is setting up a family limited partnership. If you're wanting to get your children involved in your business, you might want to set up a family limited partnership. You bring the kids on board now, and then you can retain the control. You can issue non-voting shares, you can retain a majority interest, and then you can have the voting shares yourself. And depending on how you set up the limited partnership, because it's limited, because it's restricted, you can discount the value of the asset that's in there. And a pretty aggressive discount might be 35% of what the total value of the asset is. And so sometimes people with moderately high net worths will set up a family limited partnership for the purposes of discounting the asset that's in the FLP so that the taxable amount is not as high for the taxable estate. You may also have charitable goals, and so you'd want to set up perhaps a private foundation. This is a really good one for people who want to set up scholarship funds or things like that. And they can set that up, get it qualified as a 501, I think it's 501c3, and then you accomplish your charitable goals as well. This is another one where you can bring the kids on board now, have them be a part of the foundation, and set that up. So it just depends on what your goals are and what you're trying to accomplish. So we're kind of wrapping it up here. We'll get to questions in just a little bit. But I encourage you to consider, does your estate plan reflect the tax law changes and updates? Are you taking full advantage of advanced planning options if applicable? If your net worth is nowhere near even the Biden's proposed tax plan, then you may not have as much of a concern about this. But if you or your clients have these issues, these estate sizes, then they may want to review this to make sure that they've got the best strategy in place based on what their goals are. Finishing up here with just some non-tax reasons for estate planning. And if you've attended any one of our presentations, you've probably heard us talk about this. You can avoid probate with proper trust planning upon disability or death. You can set up remarriage protection if you are in a second marriage, or you want to make sure your kids receive an inheritance. You can do asset protection for your loved ones to protect them from the possibility of divorce, lawsuits, and bankruptcy. What if they're immature? And so we talk about sudden wealth syndrome. You hand a high school kid $1 million check, or even sometimes a 21-year-old kid $1 million check, are they going to run into sudden wealth syndrome and lose all of that rather quickly? You can protect from the cost of long-term care. We do make sure that you understand a living trust does not accomplish this, but you can get out in front of your strategies with the right planning, and then ultimately just making sure you have the right people in place to help you if you need someone to make healthcare decisions and manage your assets. So these are some, I think, pretty well understood reasons for estate planning that don't have anything to do with taxes. But of course, today's topic was about taxes. And so some final considerations. I've said this before and I'm hammering it now. Your circumstances and goals will determine the optimal approach to take. And so we want you to think that through, but we also encourage you to review that with someone who understands the taxes and the strategies available. When you come into our offices, we try to make it very clear that not everything is a nail and we have one hammer. Instead, we have a lot of different tools to accomplish the different goals. And we want you to feel like that from the presentation today. We do believe, as always, that now is a great time to review this and how it applies to you. We would be happy to review this with you in a no obligation meeting. And so we encourage you to contact our offices. The number is in the screen there at the bottom corner. You can give us a call or you can visit our website. And so that is our presentation day. Thanks very much. If you are watching this live today, I'm going to end the recording and I will have a chance for questions and answers. If you're watching this later and you're not able to submit a question live, then I strongly encourage you to contact our offices, set up a phone call, set up a meeting, or send us an email so that we can answer and address those questions.